we're looking at prices continue to go substantially higher to the point that by the time we come to settle, things have already moved up so much. Finance is just so important with the whole decision process, because
in this market, you've got to do your homework first, right? If you've got the equity in your property, bridging is definitely something that can be considered. And again, it's about this opportunity cost.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
Hey Nick, thanks for joining us today. I'm really excited to get stuck into what's happening in the financial landscape. We always appreciate our chats.
Yeah, thanks, Jared. Thanks for inviting us again. It's great to be back and awesome work on the podcast. I've been listening in every week and getting a lot of knowledge. So thank you for that.
Yeah, I appreciate it. Well, you're based in Perth, and so I always like having a, sense of what's happening on the ground here. And what are you sort of seeing happen in our market? And
yeah, well, I think it's very interesting. It's sort of mad out there in home buyer world. It's really difficult for clients to be able to secure properties. We've got lots and lots and lots of first home buyer inquiries, and they're all trying to compete in the marketplace, get out there and try and secure their own home. We're seeing rentals to an end of term and in some cases not being renewed. And that's creating a sense of urgency for clients when they're going back into the market to try and find a rental. As you would know, it's extremely difficult and extremely expensive. Or when I say expensive, prices have gone up of rentals. So people are saying, well, maybe I should buy my own place, and they're seeing what's happened with the market. And it's difficult. It's difficult, particularly if you're young, inexperienced first home buyers trying to buy in a market that is super hot, because there's lots of well-meaning family and friends giving these home buyers advice who really don't understand the market. So, the dad will come in and say, oh, how much is it on the market for? We'll offer them 20 grand less than that, because that's what's been done in the past when the market's been soft. And of course, that strategy in this market is laughable because, as you would be aware, most properties are going for more than what is being asked for because of simple demand. So it's about trying to educate these clients about where the market's at, the history of the market, because even though we've had some significant growth in the last 3 or so years, the reality before that is we've had a falling market. And when you look at, I think you mentioned in one of your podcasts, when you look at sort of average growth rates, we're still below long-term averages. So even though, yes, the market is hot and yes, markets have jumped up, over a longer period of time, we're still pretty cheap, and we're pretty cheap compared to the rest of the country. So our advice to our clients is we want to really try and help them get in and secure something, because we believe from what the market is showing us that the market is going to continue to grow for some time.
Well, people are having to pay a premium on what the asking price is, and the asking price is just a bit of a guide at the moment and it gets a lot of people in the door, and then the market actually sets the price. And I say to people, it might be a premium on what the asking price is, but it's a discount on what the future price is going to be. So
yeah, that's right.
And even, I don't know if you've seen this with your clients that are in a settlement period, but even in that 6-week settlement period, we look at stuff we've bought, and because we're on the buyer's agency side very selective of our areas and choosing where there's likely to be good growth in the short term as well as the long term, we're looking at prices continue to go substantially higher to the point that by the time we come to settle, things have already moved up so much. So by waiting and missing out, they're actually costing themselves a lot more than what they might have done in just paying that little bit extra to beat out someone.
Yeah, exactly right. Exactly right. In this market, it's about, if the house or the property meets what your requirements are, well, then do everything you can to secure that property. And if you miss out, don't miss out with the feeling that, oh my word, I could have offered a bit more for that if only I'd known. It's about, well, I gave it my best offer. That's the best I could do, or the most I could do. And if I get it, absolutely fantastic. But if not, there's going to be no regrets, because in this market, there's no second opportunity. You either secure it or you don't.
Sometimes you don't even get a first opportunity.
Yeah, well, Well, exactly right. Exactly right.
And I laugh about that, but it's incredibly frustrating when you just want to see the house. And at the moment, with the average selling days being 8 days, it means half the properties are selling actually before the first home open, the other half within a couple of days of the first home open. So it is frustrating when someone's trying to get through and the East Coast investors are just pinging offers, sight unseen without often any video and well above asking price. So the chance to even see it sometimes is not there.
Yeah. I was going to ask you a question about that. I don't want to really go off topic, but when the market first started to recover, we started to see prices come up. I noticed in the market there seemed to be some real lemons out there. People would hold on to these properties that hadn't been looked after, or they're on not in a particularly good location, or whatever the situation was. And they came on the market and sort of sold off. And I suppose that's the danger when you're having to act really, really quickly, is you can't get time to do all that. But now, because the market has been on for a long time, what I've been seeing on the market, and I'm not across all markets, is there seems to be less lemons. The properties that are coming to market now seem to be more, there's a reason for the peaks of sales. So I suppose that creates a little bit more comfort for people that a lot of that stock that was less desirable has sort of been dumped already, if that makes sense.
To a certain extent, yes, but there's always lemons to be found.
I'm sure there is.
And I guess the average buyer doesn't often look at, is this next to a Homes West house? They buy it and then find out later, unfortunately. And you do need to do your diligence and check and be aware of things like your flight paths and some of the hidden things, just so that you're aware and you're making an informed decision. So,
yeah, good. Okay.
And you touched on first home buyers being pretty active. Is that the main segment of your clients that you're seeing at the moment that are doing things?
Yeah, I think it's fair to say it is. In the Perth market, there's been a lot of first home buyer activity trying to get into the market. A lot of them taking advantage of that first home deposit guarantee scheme, which is where they only really need that 5% deposit plus the cost associated with buying the property. And that's a big saving, and it means the savings for the clients in a couple of, or probably three areas. One is they need a smaller deposit because they don't also need to fund that lender's mortgage insurance.
Well, that's a huge one, yeah. No LMI.
Yeah, so that could mean they could reduce their deposit required by, say, 3%. It also means that in some cases the banks are pricing that as if it's an 80% loan, so that means they're getting a cheaper interest rate. So that's a big saving for them as well. And it's helping people buy up to that sort of $600,000 price range, because once we go across 600, we miss that. And as you'd be aware now, in Perth, it's getting extremely difficult to find quality property for first home buyers under 600,000. So yeah, that seems to be our new thing. And the first homeowners grant is really a joke, because that, it's designed for properties up to 430, and it's, there's very few properties. So I can't believe that the state government hasn't adjusted that up to the median house price or saying, we're running big budgets here and we're talking about people trying to get into their own homes, and they're not doing anything to assist in that area. So that's a real disappointment. I know it's something that REWA's been lobbying the government for, but we've seen no movement there at this stage. So yeah. So we are seeing lots of first home buyer inquiries. We're also seeing upgraders. So we're seeing people that are trying to upgrade. I've noticed in the market, again, I don't study the market like you, Jared, but it seems to me, from somebody who's sort of just talking to different clients and seeing different transactions, that the bottom of the market's really come up a long way, and yet the top of the market hasn't moved away to the same extent. So what we're seeing is some clients trying to take advantage of that. The house that might have been worth $600,000, they can get in the 800s for, and now they're going to a place for $1 million or something like that. So they're trying to upgrade. It's a tricky market to upgrade because it's hard to put a subject to sale in this market. And then we are seeing some clients going for some more premium end of the market as well. So probably plus 1.5. And there's some beautiful homes that they're buying in that market. And again, that doesn't seem to have moved away so soon. So it wouldn't surprise me if we see that top end start to move a bit more in coming times. But you'd know more about that than me.
Well, definitely, as people are up taking their equity that they've gotten the lower price points and upgrading through, and it's almost like that flowing from the bottom up now. And so what sort of ways can you help people finance-wise if they are looking to upgrade? Because it is a lot more complicated. And part of what I'm doing when I'm selling a property, I had a really complicated deal on the weekend where I'm like just trying to help the buyer be in a position to offer not subject to sale, but I still want to make sure it's all going to come together so that I'm not putting a deal together that is going to fall over. But I really wanted to, I saw that they had the extra behind them to make it possible, and I wanted them to, they also wanted to pay the best price. So I really wanted them to secure it without including that subject to sale where possible. So I helped them explore a lot of other options that they hadn't thought of. They already had a finance broker that hadn't told them these things, and I was like, yep, here's what to go and ask them. And we got the deal together, and they wouldn't have secured the property when we had another offer that was very close to it that didn't involve a subject to sale. So that's why I was really trying to help them there.
Yeah, that's fantastic. And I think, in this market, you've got to do your homework first, right? So you've got to get in and see your finance person, hopefully your broker, and meet with them and talk about strategies to see where you want. And you've got to be ready to go. So if you're looking to upgrade your home, you've got to have your home ready to go, ready to be placed on the market. So decluttered, small things fixed up. So you need to get your agent in, get it ready for settlement. So that's probably the first one of the things you need to consider. From a financing perspective, yes, certainly sitting down with your broker and saying, look, this is what we're looking to do. What is possible? A lot of clients, because of the equity they have today, bridging finance, and bridging's got a bit of a dirty name, I suppose, from years ago, but securing finance to be able to buy the new property in its entirety and then reducing that loan when you sell your existing property. The great thing today is that you can be very assured in this market, if you've got a well-presented property, maybe even if you haven't, it's going to sell very quickly and there's going to be lots of people, right? So it can be a very short period that you have the bridging. It may be that you don't even need to draw down on the bridging finance at all with dates, if you get the dates right.
Yeah. With these guys, it was just a potential backup. I wrote the settlement to be a bit longer, which my seller was happy with. And that gave them a decent window to still sell. And their agent that they'd already chosen, unfortunately, I couldn't work with them on selling it, but I chatted to their agent. Their agent was confident as well. And, they had their house ready to go. So it's now on the market this week and they're expecting to sell this weekend. So the bridging's really just a backup if they need it.
Exactly right. And there's lots of different ways we can structure that bridging. There's some good bridging products in place there. Some of the banks do it, some don't. If you go to an existing bank, they may say no because only some banks do it. It may be that we don't need to do traditional bridging, that we can look at it as you're buying another property as a potential investment if we need that, but then it changes to an owner-occupied when you sell your place. There's lots of different ways of being able to do that. But certainly, if you've got the equity in your property, bridging is definitely something that can be considered. And again, it's about this opportunity cost, that if you can get the property that you want in this market today at the right price, if you pay a little bit in interest or a little bit in bank fees to get it done, it's really insignificant compared to the growth you can potentially make on getting into the right property, particularly if you're upgrading. So yeah, absolutely, people should be looking at that. What else can they do? I think the other thing is really trying to understand the vendor of the property that's being sold, what their hot buttons is. So I'm always talking to my clients about have a chat to the agent, find out what the vendor wants, because it's not always about price. You may have an older couple that are looking to downsize, that are very nervous, have been in the property for a long, long time. So if you can give them time to find a suitable property to move to, but they want to be sure they can sell their place, and you can be flexible with that settlement period to help them, or offer them a rent back, or even a rent-free rent back for a period of time, whatever to spice it up, they are going to be more likely to take that than a quick settlement, even if the price is a bit more, because it suits them.
And finance is just so important with the whole decision process, because I just found out 5 minutes before recording that we had an offer go in last night on a property for a buyer's agent client, and our finance is really strong, pre-approved, and we were up against someone that had a much higher loan to value ratio and they weren't pre-approved and just didn't convey that confidence to the agent. So that other offer, I've subsequently found out, was $15,000 higher than us, but because they didn't have a buyer's agent, they didn't have that full confidence given to the selling agent, these sellers, for them, the most important thing wasn't price. It was surety on knowing that the property's sold, and we've given them extra time if they need it to find something. Our offer, even though it was 15,000 less, has been chosen. So
fantastic. Yeah, absolutely. So I suppose that leads on to the next thing about making sure that you are pre-approved, ready to go for finance. So I suppose the issue with that is it's the process of doing the pre-approval and the timeframes that the bank take to get the pre-approval. Some banks are doing full pre-approvals, some aren't. What we have been doing, all of our clients, is doing what we call letter of eligibility. So we get more information from the clients that we normally would. We'll do credit checks, we'll do employment checks, we'll analyse spending and go through the whole process. So this tends to work in house and land packages a lot. When people are buying a block of land, the developer wants a letter of eligibility because it can take 3 or 4 months for the building contracts and all the rest of it. And they want to make sure the clients are in a position to be able to buy and build the house. So we've been issuing those to clients, so that seems to be something that's working quite well. We have done some normal pre-approvals with lenders, and the ones that we've actually done those for are people working with buyers agents. And the reason we've done them with buyers agents is it's a call to action, and the buyers agents tend to be able to secure the property within a reasonable period of time. I've got a spreadsheet with probably 200 names from the last 12 months of people out there looking for properties. And if we did a pre-approval for every one of those, they would be all expired by now. So they only last for 3 months. So it's just sort of like an exercise in futility. And they're taking a long time is because it's difficult to buy. They're not that committed, and they occasionally go and look at a home open, but they're not. So I suppose, but like I said, when they go onto a buyer's agent, we know that they're committed. We know they want to do it, and we get a proper pre-approval. So it just depends on the client. The other thing is if a client's situation is tricky, let's say they've got some form on their credit file, their income's unusual, or they're funding right up to their maximum of their borrowing capacity, we will get a pre-approval then, or we'll suggest we get a pre-approval. And with this strategy, we've never had one client that we've met and issued this letter and sat down on the thing that we've never had an issue getting the finance approved very quickly. So we've had 100% strike rate in that. So, but again, it depends what the clients need. And if the clients need a formal pre-approval, then that's what we need to do. Yeah. But from our perspective, we would be making sure the clients are actually out there looking at properties, they're committed and they want to do it. Otherwise, there's no point because after 3 months, they're all expired. Yeah. And it's a huge amount of work to get a pre-approval. Do a full application, lodge it with the bank, massive amount of work.
So have you seen any lending stats to give us an idea as to what's happening with the different segments of first home buyers, upgraders and investors?
Yeah, look, I haven't got any across the board. I've got our own clients. So we have seen a couple of local investors in the last 3 or 4 months. A few looking to get into the investment property market. As I said, interesting enough, one was dealing with a buyer's agent company or a sort of investment company based on the East Coast, and they've actually bought in rural New South Wales. So I don't know if that's as good as it's going to, I don't know why they wouldn't be buying in Perth in this market. They're from Perth, it's their first property purchase, but that's what they've done. So we have had some investors, but again, the Perth property investors just don't seem to be really active in the market at the moment, which is a real shame. And I wish they would be, because I think there's some upside there for them. And I suppose my biggest fear is that they're going to be too late to the party and start jumping in after we've seen this growth. And that's fine if they've got a really long-term strategy. I'm a big believer in time in the market as opposed to timing the market. But the reality is with buying investment properties is most people can't do it until they're a bit older anyway, because of their life journey. They have younger children, they've got expenses, they've got a big mortgage, they've got to get equity, and then potentially they start looking to invest. So they don't have as long, right? So they might be in their late 40s or early 50s. So getting in sooner now, if you're listening and you're a first property investor, start looking at your options to get in, because it would be terrible if you missed out and everybody else on the East Coast is diving into our market and making big money. We'd like to see some local people making some money as well.
And I think a lot of owners of especially investment properties that they've had for a while might be surprised at how much equity is in there. So on a weekly basis when I'm doing appraisals for people that are curious about, what might the price be and what could I tap into equity-wise. Pretty much every time they're very surprised at how much the prices have moved and how much equity they actually have in there to use. And I say to them, yeah, well, you could have actually looked at this much earlier.
Yeah. Well, we're seeing that when we're getting valuations on properties. People are being surprised. Usually it would be somebody says, we ask the client, what do you think the house is worth? And they say, we think it's worth 700. And you get the valuation, it comes back at 620. Well, now they're saying, we think it's worth 700. It's coming back at 800. So, people are genuinely surprised by how far the market has moved. So you're right. It's a fantastic opportunity at the moment for Perth people to be able to work out a strategy, how they are going to use some of this equity to create essentially some wealth to make some big changes to their life in the future. So great time to sit down with somebody and get that strategy worked out and talk to their finance people and see what their capacity is and then make an educated decision if that's something they want to pursue. So I think, absolutely. Great time.
And what are your sort of more successful clients doing, I guess, now and what you've seen over the years? Because I always like to model what others are doing and learn from what's working.
Yeah, it was interesting. I was speaking to some clients the other day. So they're clients I've been working with for probably 20 years. When I first saw them, they wanted to upgrade their home. That's why they wanted to see me. And they had a bit of equity in their property. And I said, have you thought about buying an investment property? And they never thought about buying an investment property. And they had quite a nice home. I couldn't understand why they really wanted to upgrade the home. Sort of ticked all their boxes. So they bought an investment property. And I think today they own about 4 investment properties. And they've done the hard yards, as we all have in Perth, when the market was sort of coming backwards and their loans rolled off interest only to principal and interest. And at times it's been a little bit tough and they've had to do a bit of juggling. But I was speaking to her just the other day and said, we were just looking at our portfolio. We've got $1 million equity in the investment properties today. Now, talk about a life-changing event over 20 years. They own their own home. They've managed to do some renovations on the home. They drive nice cars now, so they're not living life large, but they've been contributing to their super. And I've just been invited to her 50th birthday and they've got $1 million equity in investment properties. You think, well, that's just life-changing, isn't it?
I'm sure it'll increase still by a lot more over the coming couple of years as well. And especially if they're only going to retire at 60, or at least they've probably got choices now. But if the horizon's still a decade away, then it should keep growing.
So they're not professionals, so they're not on massive incomes or anything like that. It's, just normal people doing that. So what do our really successful clients do? I think our successful clients, like the ones I've been looking at, they're continuing to do the basics. So I suppose one of the great things about investment property is you do pay yourself first. So that great thing to do, pay yourself first, because what they're doing is they're making the repayments on the loans. So what we're seeing now is over time, a lot of my investment clients now have transitioned to where the loans are on principal and interest, and they're finding they're able to meet those repayments pretty well. They've got significant pay down on their existing home loans, so it's almost gone or it's very small. They're now starting to pay off the investment loans, and the equity on the investment properties is increasing. They're also looking to diversify. So some of them have gone again and bought something else, diversified perhaps in location and type of property. The other thing some of the clients I've seen doing is starting to look at diversification, perhaps buying some like managed funds and stuff like that. So they've got their property portfolio. They've got good equity in that now. Now they're looking to just start to put a little bit of money into some maybe share investments, or they're looking now to salary sacrifice into super and things like that. But I think to answer your question, it's really about the difference seems to me is clients that are open, have an open mind to learn stuff, are wanting to listen to things like your podcast, look at books, and just got this want to sort of continue to learn and self-develop and see what they can do and review things. We're also getting clients, we write out to all our clients every year saying, look, we want to review your loans, that sort of stuff. It's interesting. You often have the ones that seem to be really focused on moving ahead, they're the ones that tend to come back to us and make an appointment and actually want to sit down and look at it and see what their options are, so they know what their options are. Yeah. So I think that's what they're doing. Yeah.
Well, some good tips there. So is there any changes in finance that you're seeing on the landscape that might present opportunities for different?
Yeah, I think the big changes I've seen recently have been with self-employed. So historically, when you are self-employed, particularly since the reforms we've had in the lending where it became a lot more difficult when you're self-employed rather than the old low document loans and things like that. Because basically all lenders wanted to look at your whole situation. So they wanted to look at your company financial statements, your company tax returns, your personal tax returns. They wanted to understand the big picture. And with some lenders, if you had loans inside the company, that could affect how much you could borrow on an individual basis. So a number of lenders have now come out with a more simplified policy for self-employed. And that is that if you've been in self-employed, and the policies are all different, but generally this, if you had a business that's been registered for at least 2 years and you paid yourself a salary and they can confirm that salary, they will just go off your salary. So if you have a company, you set yourself up, you can't do it if you're a trading as, you've got to be a company or a trust. But if you're set up as part of the payment system and you're paying yourself a salary of $120,000 a year, and your partner also works in the business and they make $120,000 a year, we can use those incomes as your income. And we don't need to look at all the company stuff. We don't need to take into account all the company borrowings. And that can make a big difference to some clients. But it all works in the past, right? So what they would do, if somebody came to me today, we would look at if they've got pay slips, their year to date. We'd also look at their payment summaries from their ATO portal to see what they've earned in the first 9 months of this year and annualize it. So what that means is if somebody wants to set themselves up for a borrowing capacity in the future and their situation is a little bit complicated with different companies or their company's got borrowings or whatever it is, they can say, right, let's sit down with our broker and find out how much income we need to be able to borrow the amount we want to borrow to increase our investment portfolio, and let's set that up as a salary. So we're now paying ourselves a salary. So then in 6 months' time, when we've got 6 months year to date, we can use that income. So that's a really big change, and it's certainly making things really simple. I had a guy the other day who's just bought 2 investment properties. He's self-employed, and luckily he's paid himself a salary, so it was just so simple. We had the approval through in 24 hours from the lender. The only documents I needed were his ATO payment summaries year to date and last year's year to date. Sent those in, that was it. Didn't need the financials, didn't need tax returns, didn't know all that stuff. We just need that. And like I said, it was approved in 24 hours. So that's a big change. What else has been changing? There has been some specialist lenders in that bridging space come on board, which has got some pretty good products, which we were talking about before, if people are looking to upgrade. So that's a positive. Lots of smaller lenders coming in with sort of little tweaks here and little tweaks there. So as always, it's sort of got more complicated in relation to who will do what and who won't. We seem to be using the non-majors a lot recently. We just haven't been using the majors much at all, apart from maybe some quirky policies, because the pricing has been better on some of the smaller lenders, non-major lenders. So the pricing war that we had, where banks continue to reduce margins. So I'm not talking about official rates, I'm talking about the bank's margins. They just seem to keep getting cheaper and cheaper. That seems to have come to a stop. Certainly a lot of the cashbacks that were on offer to refinance between one lender and another have stopped. There's a lender the other day that we tried to get some pricing for an existing client. They are a smaller lender out of Queensland. They came back to us and said, we will not price any of our clients with a loan under $500,000, which just seems crazy to me. So you might have a loan for $400,000. You took it out 5 years ago and your variable interest rate 6.8% or something, and you can get 6.2 with any other lender. They won't price it. So we've just written out to all those clients and say that we want to know what your interest rates are and see where you are, because they may need refinancing. So the banks keep changing their policies in relation to pricing. Sometimes they're very aggressive, and then they'll suddenly stop and they're not aggressive, and then they'll be aggressive again. So we're trying to jump in when we see good pricing from a particular bank, trying to get all those clients' loans details and see if we can get any cheaper details for our existing clients. Yeah, but that's slowed up. That really deep pricing discount has slowed up. So if you haven't had pricing done in the last few years, get it done now whilst there are still good deals about. It doesn't mean to say you necessarily need to change lenders, but it's talking to your existing lender, making sure you're on a good variable rate. And if you've got good equity in your property, you're on an owner-occupied rate, you should be paying very low sixes. So 6.1, 6.2, well, maybe 6.3 with a major. They're all good rates. But if you're paying more than that, it's too much. And for investor clients, depends if you're interest only or P&I, but I imagine a good rate, again, if it's sort of sub 80, would be round about the 6.5, maybe 6.5, 6.4, somewhere around there is a really good new to bank rate. So if you're sort of up around 7% or really high sixes, you can do better.
Well, that gives us really good ideas. Thanks for that. What do you sort of see finally for what's going to potentially happen with interest rates and lending policies moving forward?
Yeah, I mean, the regulators are still all over the lenders. The lenders want to lend money, right? They're always over it, but it's got to meet their rules. And the rules are always determined by government legislation. It's interesting to read in the news this week that there's been all these complaints put up to ASIC by borrowers who have approached the bank hardship teams because they're having problems supporting their loans repayments. So that's going to put pressure on the banks, to continue to be sort of looking at people's expenses, not being too aggressive on how much you can borrow against your income, because the heat comes on them all the time. And of course, people being people, as soon as they can't afford it, it's the bank's fault. And it doesn't seem to matter that when they took out the loan, they had no car loan, they had no afterpay. And since they took out the loan, they've got a car loan and afterpay. And now they can't afford the loan, and it's like, it's the bank's fault. So this is what some people do, the lenders. The lenders react by making sure that they are being tough on assessment. And I really can't see that changing. I think as people are struggling to meet the repayments, the regulators are going to be all over the banks again in relation to this. And they do themselves no favour because they don't make it easy for clients to talk to them. They have nobody in the branches anymore and they're closing branches, and you got to do an online form, and that makes it hard for people, and they don't get back to them. This is what some of the people are saying. So, they've really got themselves to blame for all this as well. But the reality is, for us investors wanting to borrow, want to maximise our borrowing, it's not going to get easier. So
I was kind of hoping that they'd start reducing the margin that they're testing loans at. Because is it still 3%? Which does seem crazy when we're at not recent history highs anyway.
Yeah, well, you think rates are going to go down, right? So why are we putting, makes no sense that when we could get an interest rate at 1.98, the serviceability rate was 3%, and now, we're up at 6.5%, it's 3%. And all the economists are saying rates are at the top and people can't afford any more, and next movement's down. So yeah, it's hard to work this stuff out sometimes. There are a couple of lenders that are doing it at 2%, but they tend to have a higher interest rate because they do stuff the other banks do. But there are certainly some lenders that have some higher borrowing capacities than other lenders. And there's some refinancing come in now that if the repayments aren't increasing and it's for the client's benefit and you're sort of refinancing dollar for dollar, they won't worry about the serviceability rate. So it's a quick refinance. So that makes good as well, because there were some people where they're locked in on a really high rate. They can't refinance because they can't meet serviceability. Those clients are worth re-looking at today because they may be able to under those new rules. But for new to bank, new borrowing, new acquisitions, I think it's still going to be reasonably tight. I think from a borrower's perspective, we need to be mindful again of things. We've spoken about it before, but afterpay is a commitment and there's an approved limit there, and the banks will make an allowance for that as a debt and a repayment, so that reduces your borrowing capacity. Credit card limits, doesn't matter if you never use the credit card, doesn't matter if you pay it off every month and you're only getting it for your frequent flyer points, it's still a liability and will reduce your borrowing capacity. Big Brother is watching us these days with this positive credit reporting.
Well, I'm sure the technology is only just scratching the surface soon. Who knows what they'll have with AI and other stuff.
Yeah, there's heaps coming. So there's this thing called smart banking where they'll be able to scrape data. Credit file is becoming more important. So I think people just need to make sure they're being responsible. They're not making inquiries willy-nilly for credit, only if they really need to. car loans are an interesting thing. People think they do the right thing responsibly by getting a car loan. So I'll put it over 3 years because I want to pay it off quickly. And that's great financial sense, unless you want to apply for a home loan and you've got this really high car repayment, and now it's going to be a hindrance. So again, we would, if we were doing that loan, we would look to see if, maybe what we need to do is refinance that car loan over a 7-year period to get the repayments down so they can meet their home loan requirements. So I suppose it's just, I think you've got to talk to people in the know because it's complicated. There's all these little things that can trick you up. So if you're thinking about doing something, even if it's a while away in the future, come in and see somebody and say, look, this is what I'm wanting to do. I just want to make sure I'm getting all my ducks in a row. This is where I'm at. What can I do today? And what do I need to be aware of? And having that discussion and just making sure that you execute that plan. So then when you do want to go, you are in a position to do it. I think the days of just wandering out on the weekend, and you would notice yourself because you saw the home open sign and then going in and think, we might buy that. It's just, you can't do it. You've just got to get all this pre-work done before to make sure that you are actually somebody who can borrow and eligible. Everybody's too busy to be wasting their time with people that haven't done their pre-work.
Yeah, well, that's a good place to end things on because I don't want people to feel overwhelmed by some of the finer details and complexity we have spoken about today, but the sort of cut-through message is if you work with the right people, it can be a lot easier and simpler, and putting in the planning and preparation makes the rest of it go smoothly. So,
great summary there, Joe. Fantastic. Well done. Yeah.
No worries. Well, thanks for joining us, mate. Really appreciate all your insights, and we'll catch you again sometime down the track. There's always things changing in finance.
There always is. I'm saying so boring, it's quite interesting. All right, I'll see you later.
Yeah.
Bye.
Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.